19, 2022. Okay, so you can come and take one each. Yeah, there is. Sign up. Okay, so this is today's attendance sign up. Right. I'm going to cover chapter 9 today, and then I'm going to give you some hints to concept 6, and then we'll try to do the student evaluation if we have time. I really want to do it today, so I have to leave about 10 minutes. We have to have about 10 minutes to do the student feedback. Concerning your concept 4 answer key, I sometimes don't bring this with me. It will be in my office, so I'm sorry. Yeah, I cannot bring with me everything. There's too many things. So yeah.
After class?
Yeah.
Okay, thank you.
Oh, you're lucky. Answer key concept 4, right?
Yeah,
okay.
Thank you.
Right. Okay, so sorry? The midterm 2? Yeah. Okay, yeah, some of you haven't picked up your midterm 2 yet, right? So okay. Is that right? Is that what you're saying? So what's your name? John Miller? Okay. Okay. Who else? How many of you? So your right. So you want to pick up your stuff, right? So you said one point has been deducted, and then you do 2, right?
Yeah.
Okay. I think it's fine. Just let me know. Which one is it here? So let's Right, I see. Okay. Right, yeah, okay. Oh, I see, okay, fine. Okay. So, let me just change this. This should be Z minus 2. Right? So, it becomes yeah. It's in my phone. Okay. All right. Let's do chapter 9. Okay. So I hope to finish chapter 9 today. As I said, there's no difficult models here. So you know, you can just read most of the stuff. So my role here is just to guide you about what's the main point that you have to pay attention to, and then you can read the book yourself. Okay. So this chapter is about financial globalization, and then the next chapter will be about developing countries. So these are important topics, of course. So today we talk about financial globalization. Okay. So financial globalization is important, especially after we have gone through the global financial crisis in 2000, starting from 2008 and lasted for such a long time. The global financial crisis that started in 2008 was considered to be the biggest global recession since the Great Depression. It's very, very serious. This is the biggest global recession since the Great Depression, which happened in 1929. And the reason many people say has a lot to do with financial globalization. Has a lot to do with financial globalization, and because there's a lot of what do we mean by financial globalization? Well, we mean that there's a lot more international banking, and banks are linked to each other. So banks will deposit with each other. So one bank will have deposit on another bank will have deposit with other banks. The banks are kind of connected with each other through their deposit. And also, banks begin to securitize their loans. Okay, so they kind of begin to issue securities, use their loan to back up the security, and then sell this security all over the world. And as the risk behind the securities are not very clear, and as a result, when some banks begin to fail, some loans begin to fail, these securities also become problematic, and there will be default with this kind of what we call asset-backed securities. Asset-backed securities. Okay, these asset-backed securities include, for example, the mortgage. Okay, the mortgage. So banks will lend money to people, especially it started in the U.S., but also in other countries as well. But U.S. is the biggest place. It's the biggest market where banks will lend money or mortgage to people, but these people are actually not. Their payment ability is actually questionable. So that's what we call the subprime mortgage, right? So they're actually these people are not really quite qualified for this mortgage loan, but the banks continue to lend them, so become risky. Okay, so when the property market just keep rising, it's not a problem. But when the property market the property bubble begin to burst, you know, these the property value of these on which this mortgage borrowed, you know, drop, and then people cannot pay back the loan, and so they default on the mortgage. But because these banks actually sell the securities based on this mortgage, you see, so when you're holding a security issued by, let's say, Lehman Brothers, for example, okay, so you buy some security issued by Lehman Brothers, but in fact this security, you know, is you are actually lending money, indirectly lending money to the subprime mortgage holders who default. So you're also in big trouble. So that's why you have this securitization of bank loans. Is a new development. Okay, this is new development in financial technology, in financial engineering, so to speak. I wouldn't say a financial technology. Financial technology refers to something else. But financial engineering, you know, we have this derivatives, and so this is another aspect of financial globalization, because these securities, bank issues asset-backed security or mortgage-backed securities, they are actually sold all over the world, not just in the U.S. They are even sold in Hong Kong, okay? Even though it's issued by some American companies, American banks. So financial globalization had this kind of thing, okay? So you can see that especially American banks, banking, and American financial institutions and European financial institutions are so integrated. And that actually can explain why the financial crisis became so big in scale, partly because of this globalization, okay? Integration between European and American financial institutions. So when the U.S. tried to rescue banks, they did not just rescue American banks, they actually had to rescue European banks, okay? The Americans, when they try to rescue banks, they actually have to rescue UBS, which is a Swiss bank, precisely because these banks are they are actually doing business all over the world, and actually not clear, you know, whether in fact a bank like UBS might have more business in the U.S. than in Europe. So so that's why you know you have to rescue foreign banks as well. So this all become integrated, and then you have a problem. So this chapter, in this chapter, we're gonna talk about talk about financial globalization. What is financial globalization? Why is it good? What are the good things about it? And we talk about the international capital market. We talk about offshore banking. We talk about offshore currency market, which is closely related to offshore banking. And then we'll talk about what are the government safeguards against financial instability. What are the safeguards? What were the safeguards? And by especially the U.S., for example, the reason why we have to look at U.S. is because U.S. is supposed to be the most mature financial system in the world. So what have been the safeguard in the U.S. And that other countries should be following, right? But there are also something about international banking that has to be regulated, because there is no one global government, right? But then, because banking is so international in nature, how do you regulate? Okay, so it's sort of, there is to fill that gap. There is this what we call the Basel or Basel agreements. There's Basel I, Basel II, Basel III, which governs international banking or provide guidelines to international banking so as to fill the so as to fill these fill this gap in regulation in international banking. There's a lot of things here, but as I said, once you get the main point, that the rest is just detail that you can read yourself. So my role is just to point out the most important things. So first of all, we'll talk about international portfolio diversification, and then regulation, supervision of international banking, and then the degree of international financial integration. So first of all, we start with gains from trade. Why do we talk about that? Because financial globalization is supposed to be good, okay, to begin with. So it's supposed to be good. I mean, don't get it wrong and say, oh, it's all wrong, it's all mistake. In the global financial crisis in 2008 was a total mistake. The world should not have been integrated. That should not be financial globalization. And that's not true, in fact, because the original purpose of financial globalization was actually good because of a lot of gains. So we're going to talk about the gains from trade. Well, there are different kind of trade. We're going to talk about that. We're going to talk about the international capital market, offshore banking, all that kind of thing. Okay. So first of all, we'll talk about the international capital market. Just by way of introduction, the international capital market is actually a group of markets, and they sell, foreigners can participate in any of these things, okay? Stocks, bonds, deposits, you can buy commodity for, so there's very little restriction for foreigners to participate in this. So these countries typically they have open capital account. The capital account is open. This is of course unlike for example China or Malaysia or Taiwan. I mean these countries have restricted capital market, restricted capital account, so they cannot participate in this kind of international capital market. In order to participate in the international capital market, you need to have free capital mobility, such as in Hong Kong and U.S., UK, Singapore, and all these places. So what are the gains from trade? There are actually three. There are by and large three types of gains from trade. What do you mean by trade? So you have trade in goods and services as well as trade in assets. Okay. So trade in goods and services are obvious, right? This is called the current account transaction, right? Current account. This is like at the present moment, I sell some goods and services to you. You sell some goods and services to me. That is the gains from trade in the narrow sense, and oftentimes that is driven by comparative advantage. Comparative advantage, right? So in this course we did not cover the real side of international trade, but trade in goods and services are often driven by comparative advantage. For example, China has comparative advantage in labor-intensive goods, okay, whereas a country like Japan has comparative advantage in capital-intensive goods. Country like U.S. has comparative advantage in perhaps technology-intensive goods, innovation-intensive goods, maybe in the case of the U.S. By specializing in the sectors in which they have comparative advantage, and then countries trade with each other, they'll gain from trade. Okay, and this gain from trade is in the current account. Okay, so it's reflected in the current account. But there is also other gains. So this diagram is actually a very good diagram to show you the three types of gain from trade. So here, okay, so you have two countries, right, home and foreign, and then your home has goods and services, and foreign has goods and services, home has some assets, and foreign has some assets, right? So these assets are maybe stocks or bonds, right? So when home and foreign trade goods and services with each other, that's reflected in the current account, and that gain is from comparative advantage. Comparative advantage. But when home trade goods and services are for asset with foreign, or foreign trade goods and services for asset with home, that's another kind of trade. Can anybody tell me what kind of trade this is? When foreign sell goods and services to home, but home sell the asset to foreign, what is the nature of this kind of trade?
Intertemporal trade.
Intertemporal trade, very good. It's intertemporal trade. It's because, why? Because when this takes place, home is in fact, is in fact borrowing money from foreign. Okay, home actually sells, an asset, a claim to foreign, and foreign actually give the goods and services to home. So home is actually borrowing money, is get the goods and give a piece of paper to the other side. Is a claim that you are supposed to be able to claim something, some goods and services from me in the future. Okay, an asset is something like that. An asset is a claim that you can use to claim future goods and services. Okay, so that is an intertemporal trade. This is also intertemporal trade, right? So very good. So that's the second kind of gains from trade. Countries will gain because sometimes I might need to run current account deficit. I have to borrow money from foreigners because perhaps my investment opportunity is very high here. So I would borrow money from foreigners to invest in my own economy because the return to investment is very high in my economy. If I borrow money from you, maybe I borrow at 3%, but my investment return is 10%. So it's actually a good thing, right? So current account deficit may not be a bad thing. So that is reflected in the this kind of intertemporal trade is reflected in the financial account, right? In the temporal trade. But there's also one more kind, which is selling assets to each other. So U.S. May sell some stocks and bonds to British, and Britain may sell some stock and bonds to Americans. So they sell. Why do they sell this to each other? What is the market incentive for doing that? Yeah.
Lowering the risk.
Lowering the risk, right? So you want to diversify your risk. You want to, yeah, that's precisely right. So you have, always better to diversify. Okay, this number one rule of investment is to diversify as much as possible, right? So there's three types of gains. Okay, the first type is from comparative advantage. Second is intertemporal trade, and third kind is portfolio diversification. So where does the capital market play the role? Well, obviously, international capital market obviously play a very important role here because it facilitates intertemporal trade as well as facilitate the asset-to-asset diversification, portfolio diversification, right? So here is just an example to tell you, it's so simple, I don't even need to go into the detail. So you're talking about, you have just two countries, they are located in two different, their farmlands are in two different countries, and the weather in the two countries are actually quite different, okay? So when the weather in one country is good, the weather in the other country is bad. When the weather in one country is good and the other is bad, then then it will be actually beneficial for the people in both countries to trade asset with each other. You see, because this will diversify your risk. on average, the land will produce 60 tons in bad weather, but 100 tons in good weather. But you don't want to have this fluctuation in your consumption. You want to have smooth consumption. So as a result, you actually want to sell 50% of the ownership of your land to the foreigners, to each other, so you get what? They can both gain if they're risk averse. If you're risk averse, then you would insure you against this kind of fluctuation in consumption. Okay, that's quite. Sorry, it's 20. So if the weather is good, it's 100. If the weather is bad, it's 20. Okay, I misspoke just now. So on the average, you get 60 if you insure with each other. So basically, asset diversification, portfolio diversification is like insurance. It's basically like insurance. Okay. And people usually are risk averse. If they're risk averse, then you want to buy insurance, and this is one way to do it. It's just very simple. Assets, there are, you obviously know there are debt assets, there are bonds in particular. Bond is the primary example of debt, and then equity will be stocks. All right. Basically, there are these two types, and to participate in the international capital market, of course, commercial banks and financial institutions, depository institutions are the main player, of course, but they are not the only ones. There are also other investment banks as well. Okay, there are non-bank financial institutions such as insurance company, mutual funds, securities firms. Okay, they also participate in the international capital market. Okay, so they buy. They often will buy. Oftentimes, these are a lot of these times. These are asset management companies, right? So insurance company, they will just buy assets in this international financial market. There are also private firms. These private firms will be selling their assets, oftentimes issue bonds, issue stocks, and then the central bank and government agency often will buy and sell this kind of assets to influence foreign exchange markets, okay, or foreign exchange rate, and so on. So this then involve then we talk about offshore banking, because commercial banks are the biggest player in the international capital market. So you have to talk about banks, right? So in the case of, let's say, Hong Kong, you have a lot of offshore banks, obviously. There are hundreds of banks in Hong Kong. The biggest ones are all in Hong Kong. You have Citibank, you have UBS, you have HSBC, and all these. So these are offshore banks. These are international banks, and there are several types, and I'm not going to go into detail of these different types of banks. So if you ask me, what is Citibank in Hong Kong? What is Citibank? Is it an agency office, or is it a subsidiary bank, or is it a foreign branch? Honestly, I can't tell. I think it's probably either a subsidiary bank or foreign branch, Citibank in Hong Kong. But there's some subtle difference. I think this is the difference is in terms of whether they receive deposits, and whether maybe the profit is repatriated, whether the account is separated, right? The foreign foreign office profit, is it separated from the profit of parent company? I mean, that kind of thing, which is not very important to us. They are foreign banks anyway. So, and then you also have the offshore currency deposit, and this is very interesting. Because like in Hong Kong, you find it so convenient, right? So you go to HSBC in Hong Kong and you say, I want to open up 10 different currencies, account for 10 different currencies. They immediately do it for you. So it's so easy. It's so convenient. It's not used to be like that, but you can clearly see offshore currency deposit very much in action in Hong Kong. Okay. So you say, okay, I open up a US dollar account with HSBC. So I didn't really think about it carefully, because probably because I didn't have much in the account, right? If I have much in the account, then I have to be very careful. I think about, what if the bank failed? What happened to my US dollar deposit in that bank? I can tell you, if it's offshore US dollar, you probably don't get much protection. So you don't have this deposit insurance kind of thing. So you have to be very careful, okay? It's unlike like in Hong Kong. So for example, if I have a Hong Kong dollar deposit account in a Hong Kong bank, I'm actually protected by the deposit insurance up to a certain amount of money. So if the bank goes under, my deposit is totally protected by the deposit insurance, but not for international currency. So if I have US dollar account, if the bank go under, my US dollar deposit is not protected. So that's the problem. That's the problem, you see. The protection, it's not there oftentimes. And there are other things. There are other things that is also different when you have offshore currency deposit. So offshore currency trading has grown more and more because of growth in international trade and also growth in international asset transactions, just because of the growth in international transactions. And also there is, historically, it's also because of the avoidance of regulation. This is particularly true of the US dollar offshore market. The US dollar offshore market has a history of its own, which is very interesting. Okay, the US dollar offshore market used to be called Euro dollar, which is a very bad name, which is a very misleading name, but it's called Euro dollar. Okay, so Euro dollar market, it started all the way back to the 1960s. US dollar offshore market developed mostly in Europe, especially in London, where some banks in London will actually accept US dollar deposit, okay, in London, and then they will actually make loans as well in US dollar outside of the US. So this is called Euro dollar market, and it was triggered partly because of regulation, okay? Because they want to get away from the U.S. government's regulation. They can actually offer better deposit rate and also charge higher rates in their loans. They can get away from this kind of regulation. And also, during the Cold War period, the Soviet Union used to want to keep US dollar account, but they didn't want to keep the US dollar account in the US. They want to keep US dollar account outside of the US for political reasons. So that also leads to the strife of US dollar, offshore US dollar market. So there is this kind of thing. In the case of just as a digression, about the RMB offshore market. Okay, now we're talking about the RMB international, RMB offshore market in Hong Kong. So RMB offshore market is another offshore market, which is which is a little bit different, of course. RMB offshore market is a market which was largely created by the Chinese government for other purposes, for the internationalization of the currency. So again, it will be subject to different forces. So the offshore market of a currency is subject to different forces. So it's a different, same currency, but the market is slightly different. Okay, so that's the thing. So so we talk about there are a few things we want to talk about. The reserve requirements are is one thing that that sort of trigger why some U.S. bank back in those days, back in the 60s and 70s, why some U.S. banks want to move offshore and do business offshore is because of reserve requirement. So because if you move offshore, there's no reserve requirement, okay, and so you don't have to put a certain amount of the deposit with the Federal Reserve, and so you have more money to lend out. You have more money to lend out. So so that is one reason. There are also other reasons. The interest rate. There are also interest rate restrictions. It's called Regulation Q. And that actually the kind of interest rate restriction also is a intervention into the market, and so the some U.S. banks try to get away from it. So it's in a sense, this is what we call regulatory arbitrage. Okay, remember this term, regulatory arbitrage. So firms will try to arbitrage regulation, meaning that they try to get away from the regulation of one country and go to a jurisdiction where the regulation is more lax. Okay, so reserve requirement is one thing. So their reserve requirements is actually for the original intention of reserve requirement was good. Okay, it's a kind of regulation. So when a central bank requires a reserve requirement from the commercial bank, it's because they want to make sure that there's enough money there in case customers want to withdraw their money. Okay, there's enough reserve there to give to the customers. Okay, if you don't have enough reserve, you have to run a higher risk of bank run. Okay, so that was the original intention, and also so banks can fail. Okay. And so there needs to be regulation, basically, okay? So we talk about financial banking and financial fragility. Okay, so what's interesting is that the banking system is actually fragile, okay? We all seem to be very complacent. I think most people don't worry about that the banking system may fail, but in fact, the banking system is actually quite fragile. Okay, as the 2008 recessions have demonstrated, the banking system can be very fragile, and there's lots of regulation that is required. Okay, so that's the capitalist system itself is fragile. Okay. So there is, as a result of that, there needs to be regulation. So this whole idea, the next few slides, we're going to talk about these regulations or government intervention that is required to intervene in the banking system, because the banking system itself is inherently fragile. Okay, you have to understand this very, very well. Actually, when you talk about banking and money and banking, you know, you have to realize that the banking system is actually quite fragile and requires regulation. Any country in which regulation is not well enough is actually risky. So back in the Asian financial crisis in 1998, part of the reason why there's this crisis was because the banking sector is not well regulated. There's no good regulation. Okay, so here is just we talk about a number of safeguards. This regulation. One is what we call deposit insurance. You all know what it is, right? So that is in case there's in case a bank actually goes bankrupt, the depositors will be protected 100% actually, up to in the case of the U.S. It's that amount. In the case of Hong Kong, it's another amount, and that will give confidence to depositors and prevent them from going, you know, to bank run. Okay, so bank run was a big problem when you don't have the deposit insurance, because once the confidence in the bank is eroded, everybody wants to get back the deposit. But if you have deposit insurance, people will have their mind at ease, and there's no problem. So that is a very, very important measure. But of course, it also creates a problem, which is called moral hazard. Okay, moral hazard means banks know that deposits are insured, and so they will take excessive risk as a result of that, because they know that nobody will come. There will be no bank run. Okay, nobody will come and try to get back the deposit when there is some problem. So they may take excessive risk. The second thing is reserve requirement, as I already said. The third one is capital requirement. Capital requirement is different. It's different from reserve requirement. Capital requirement is actually the amount of the asset that has to be actually owned by the owners of the bank. Okay, so the owners of the bank have to put in a certain percentage in the bank asset. They have to actually own the asset. So in case the bank fails, they actually lose money. They also actually lose because they actually put their money on the asset. Okay. This is called capital requirement. Okay? The capital of the bank has to come. A certain percentage of the capital of the bank has to come from the owners. Okay. The fourth one is the bank examination, which is, you know, regular examination of the book of the bank, the account, the balance sheet, regular examination. Okay. And then lender of last resort. Okay. All the countries in all countries in the world have a central bank, and this central bank will be the lender of last resort. So lender of last resort, because the central bank can print money. They can print money. So if a bank fails or begin to fail, the central bank can print money and lend money to the banks and to prevent them from failing. Okay, and prevent bank panics. Okay. Again, this will create moral hazard. This lender of last resort will create moral hazard precisely because of the same reason that we said before. Because the banks know that they will be rescued in case they have problem, so they may take excessive risk, such as what? Excessive risk will be, you lend to some more risky borrowers, or you lend to real estate investment. Okay. So a lot of times real estate is a big problem. you know, the global financial crisis in the U.S. in 2008 was actually also related to real estate, right? So, although the bank, in the case of the 2008 global financial crisis in the U.S., the banks did not itself invest in real estate development. They actually they actually lend out a lot of loans to unqualified borrowers, okay, which is equally bad. Okay, so because so what I'm saying is that you have moral hazard. Okay, once you have this kind of land of last resort, you have moral hazard. The bailout, government organized bailout is actually similar. It's again the rescue by the government, but that is even a last resort thing. When you have the bailout, it's really the last resort. Okay, even if if you lend money to the bank is still not enough, the government actually have to, in fact, sometimes take over the bank, take over the bank, and actually that took over. But I think that actually happened. I think that happened during the 2008 financial crisis in the U.S. I believe probably Citibank. I can't remember which bank, but some banks actually was under was actually it was taken over by the government briefly. Yeah.
So if these banks were going to fail, wouldn't it be better to just let them fail?
Well, yeah, that is a debate. There's always a debate there. Some people say that just let them fail, right? This is just the market, right? Just like any other market. If the firm doesn't perform well, they are just they lose money and they just let them fail. But then there is also another side of the argument say that okay, these financial institutions are very important. They have lots of what we call externality. There's lots of externality when the firm failed. It's not just this bank failed, but it also affects other businesses or other banks. So it has this externality, external effect that is the cause. The cause of the bank failure is not only borne by the bank itself, but also borne by other companies and firms. So that's why they justify this, and they call it too big to fail. Okay, you've heard of this too big to fail idea. Okay. This phrase has been repeated again and again. So a lot of times these big banks are considered too big to fail because they are so big. They have lots of external effect. When they fail, they will drag down other businesses or banks or firms. So it's still under debate. So you have a very good point. It's still under debate whether you should rescue. Yeah.
And what would you actually, like, how do you actually evaluate
whether to rescue or not?
Yeah.
It's actually very hard to evaluate. Is there any objective way of evaluating it? Is there any number you can? Is there any measurement you can use and then feed those numbers into a formula and decide if this number is larger than this, then you rescue. If this number is less than that, you don't rescue. It's not easy to have that kind of objective thing. It's oftentimes hard to evaluate what are the external effects. So oftentimes the outcome becomes for example, the judgment of the authority. So for example, whether or not they should have rescued Lehman Brothers back in 2008, in September of 2008, I still remember. I was actually living in the U.S. I was working in the Federal Reserve Bank of Dallas at that time. So I was working in the Central Bank of the U.S. at that time. So So they want to decide whether or not to rescue Lehman Brothers. And then eventually, Ben Bernanke, the chair of the Federal Reserve, said they actually tried, but nobody was willing to buy. So they tried to ask some other banks to buy Lehman Brothers, but nobody is willing. So then the question is whether the US government should take it. Then they decide not to. They find that it's already maybe too late. They have already rescued another company called Bear Stearns. They actually rescued Bear Stearns earlier in 2018, in around May or something. So that was already a big rescue operation. So if you rescue Bear Stearns, you would rescue Lehman Brothers. Who is the next? You rescue Goldman Sachs or whatever. So that's a point where you have to stop, and then there's a big debate within the Federal Reserve and also within the Treasury. At that time, Henry Paulson was the Treasury Secretary. The Federal Reserve Chairman was Ben Bernanke. And then these two people are the two main personnel making that decision eventually not to rescue Lehman Brothers. It was I think it's a good decision. It's too late to do it. As you said, you would be, if you rescue Lehman Brothers, then maybe soon after it would be another company that you have to rescue. So how many can you rescue? And then after you rescue, these companies are actually losing. They are actually non-viable. So it's not clear whether just maintaining their existence is useful. So just let them fail and then do other things. Okay. Of course, it was a very hard decision. Yeah. There are many other things they try to do other than rescue, not rescuing or rescuing. They rescued Bear Stearns earlier in the year, as I said. They did not rescue Lehman Brothers, and then but they, in fact, they actually lowered interest rate in the beginning of 2007. In the beginning of 2008, actually, I should say, January 2008, the Federal Reserve already saw that there was a big problem coming. So even before, you know, the Federal Reserve actually hold an open market committee meeting every 6 weeks. But during each open market open market committee meeting, they decide the interest rate. But then in January of 2008, Ben Bernanke actually decided to lower interest rate many times between the two open market committee meetings. So they saw a lot of problems coming, and so anyway, so what I'm trying to say is that perhaps it's a lot of judgment. It's a lot of judgment. At the end, it becomes a judgment by the leaders in this kind of situation. I think you have a good point. Perhaps in the future, people should have a better way to evaluate what to do. But oftentimes it's judgment. Yeah, that's the thing. So that's why it's fragile. I keep saying that the capitalist system is fragile. The capitalist banking system is fragile. It's actually in the hands of a few people. Can you believe it? Okay. So, and then there's lots of banking crises, since during this period, just to show you how fragile is the banking system. So, as I said, there's a difficulty in regulated international banking, right? So you have Deposit insurance is hard to implement. Reserve requirement hard. Bank examination again is hard because, like, you know, when let's say for example, HSBC has a U.S. dollar, or Citibank has a U.S. dollar deposit account in Hong Kong. Does the Hong Kong authority care? Well, I mean, it's U.S. dollar. I mean, Hong Kong authority, well, you should care less about U.S. dollar deposit. It's not, you know, it's some foreign money. You know, Hong Kong Monetary Authority cares most about the stability, the financial stability of the Hong Kong dollar-based financial system, not the U.S. dollar-based kind of accounts. So bank examination becomes less of a concern. You know, it becomes a sort of a gray area. So no lender of last resort. Also non-bank financial institutions also have lots of activities, international activities. And again, there's very little regulation. These so-called non-bank financial institutions, what are they? Well, there are lots of such. You know, insurance company, you know, asset management company, you know, all these kind of, they will be selling assets to people. Okay, so in fact, Lehman Brothers, you know that in Hong Kong, actually Lehman Brothers also sold this so-called mini bonds in Hong Kong, and then people lost money. Some Hong Kong people lost money, and then they protested in the street. But it's not well regulated. That's why, you know, it's not well regulated. So again, it's a derivative, and all this securitized asset. It's because they package, you know, this security, you know, this asset-backed security, in a way that it's so hard to decipher the risk involved in the asset. So, I mean, another example, again, the example of Lehman Brothers, this mini bonds, you don't really know what is behind these mini bonds. I mean, how much of it consists of subprime lending, how much of it consists of you know, lending to other banks and all that kind of thing. This derivative is hard. So that's a problem with financial engineering. So financial engineering was supposed to be making the financial market efficient, but it also carries a lot of risk. And regulation is hard to come by. So yeah, again, I talk about regulatory arbitrage. You know, so banks will shift to other jurisdictions. So again, there's something called the financial trilemma, which I basically, it's that this is not the same as the open economy trilemma. They're very, very, very different. They're completely different things. It's basically saying that there's a trade-off. There's a trade-off among these three things. You can only have two out of these three. So all of them are may be desirable. All of them may be desirable, but oftentimes number two is hard to number two is something that any democratic country will want to have. Okay, a democratic country will want to have number two, national control. In other words, you don't let other countries determine what kind of regulation you need. But other countries may have very lax regulation. Okay, so do you want to follow the lax regulation? If you follow the lax regulation, then you have to forego two. If you have, then you may have 1 and 3. Okay, so I'm not going to go into detail of this. You can read it. So the international regulatory cooperation, that is what we call the Basel Accord. In fact, there are 3. Started from 1988, and then there is I think there's another one, and that's Basel 1, Basel 2, Basel 3. So they all are related to provide standard regulations and accounting for international financial institutions, especially banks. Okay, so especially this is about capital requirement, for example. It's a very important thing. Okay, capital requirement is an important thing, and then yeah, so capital requirement here. Try to make bank capital measurement standard. That's a measurement issue here, and that's also the core principles of effective banking supervision. So this is especially important for developing countries. Okay, they will have to a good guideline to follow. And then, so in 2010, after the global financial crisis, the Basel Committee proposed a tougher set of capital standards and regulatory safeguards. It's called Basel III. Okay. So this basically is hope to this. You know, Basel is a city in Switzerland. So they try to create some international standards, hoping to make international banking safer. And then there's also this macro-prudential perspective. So this is basically from national policy. Okay, national policy is to have some macro policy, not to aim at individual banks. Okay, it's not regulating banks, but some policy which is sort of macro in nature. For example, restriction of capital flow. Okay, that is called macro-prudential policy. Some people talk about Tobin tax. I don't know whether you've heard of it. Tobin tax is a tax on capital capital inflow. Okay, so you try to restrict capital inflow. You try to restrict hot money flowing too quickly. So you have a tax if the money comes in and stay for too short a time, then they have to pay a tax. So you want the money to stay longer. So this is a kind of what we call the macro-prudential policy. Okay. So so there are lots of such things. People talk about this kind of thing. So Tobin tax is one thing that people talk a lot. Okay, Tobin tax to regulate short-term capital flow. Right? It's actually even being talked about in Europe. It's not just for developing countries. Some developing countries go far further than that. They try to impose capital control and that kind of thing. So I guess I will. I'm not going to hold you responsible for the rest of this. This is just a little bit more academic in this. So you're not required for the rest of this. Just try to some academic study try to assess how well the international financial markets allocated capital and risk. It turns out that it's not very conclusive, actually. It's not very conclusive. People find mixed evidence about whether the international capital market is indeed, integrating the world. Whether it has helped to allocate resources efficiently. Remember, in the beginning, we say, international capital market is good because it integrates the world and it facilitates gains from trade, right? Three types of gains from trade: asset to asset, asset to goods and services, and goods and services and asset. So these gains from trade are supposed to be good and. But has the international capital market really achieved that aim? So some academic study, they use econometric technique and so on to assess it. And the outcome is mixed, actually. So that's the idea. All right? So I think that's it for the lecture. I do have some, of course, I asked you to, you know, read these guidelines, right? So I think these guidelines are useful. You remember I asked you to answer these questions, right? I think I already answered. Well, after I've gone through the slides, you should be able to answer these questions yourself. Okay? Let's use these as guidelines. Yeah. Right.
In terms of international lender of last resort, does Bank of International Settlement not do that at all?
No. There's no international lender of last resort. There is no such thing.
Okay.
There's no international lender of last resort. That's the problem. Because the national central bank only cares about its own country, about the health of the banking system in its own country. So there's no international lender of last resort. That's the problem. The BIS doesn't do that. The BIS only sets standards. Yeah. Yeah. The BIS is the Bank for International Settlement, which is the organization behind the Basel 1, 2, 3. So I'm not going to go through these things, but I do. I can give you, you know, again, answer key to these to this set of questions. So so you can so another set of handout. I don't have space to put it actually. Is this okay? So I have another set of handout here. You can take one here. This is for chapter 9. In fact, I do have another one for chapter 8. You know, in chapter 8, we also talk about. I also gave you a number of questions, right? Study questions. You should use this study question as a guideline for your studying. You remember I asked you these questions, right? Again, since I have already gone through the slides, you should be able to answer these questions. Okay? So these are the suggested answer key I put in here, so you know what I have in mind. Any questions? Any questions? Okay. Now, one more thing. You have the last homework due tomorrow, right? So let me just go through this to give you perhaps some hint. Problem set, right? So you have the problem set number 6. This is problem set number 6. So here are a number of questions, right? So first one is about, so now, problem set 6, right, it consists of some stuff which I have not taught yet. Again, well, in fact, you know, I'm going to teach it on Thursday, so you may as well just study it yourself, learning by doing. We call this by learning by doing. So so then on Thursday, when I discuss those things, you have already have read the stuff. So I think this is not a bad thing, and we're rather generous in terms of our grading of the homework. So the first question is really actually related to what? It says that in this case, in the U.S. case, it's interesting. The foreign exchange intervention is not done by the central bank. Okay, it's actually done by the Treasury, by the Department of Treasury in the U.S. So the question is to ask you: suppose the Treasury, which is not a central bank, intervene into the foreign exchange market to support the yen, and explain why this is automatically sterilized and does not affect the money supply of the U.S. So in other words, here is a situation where the U.S. want to intervene in the foreign exchange market and try to buy the yen and sell the dollar, so to support the yen exchange rate. But because this is not done by the central bank, therefore, it is automatically sterilized. So I want to ask you why it is automatically sterilized. And then second, if an increase in, so here is the second one, is to ask, it's a little bit related to the imperfect asset, imperfect substitutability of asset. So assuming that if the private sector holds more dollar-denominated bonds, then the risk premium will increase. Okay, suppose we have a risk premium. Okay, you have a yen. This is the U.S. dollar interest rate, and there is the foreign dollar interest rate, foreign currency, and then you have a risk premium. Okay, and this risk premium, in fact, this thing increases as private sector holds a higher percentage of outstanding U.S. dollar bonds. U.S. dollar bonds. So if this is the case, it wants to ask you. It asks you whether the risk premium increases or decreases. How does it affect the role in this case? Okay. So remember, they would sell or buy bonds. So finally, write down the uncovered interest parity condition. Then use the equation how such an affect the uncovered and how it affects the dollar-yen exchange rate based on assumption. So based on assumption of this, so this is the sort of uncovered interest parity condition, right? See how this is going to affect the uncovered interest parity condition and how it affects the dollar-yen exchange rate. This is an unsterilized intervention. You have to remember, the money supply supposedly doesn't change, but you have to answer part A first, okay? And so the question is okay. So question number 2 is very easy. It just asks you, suppose the buyer of foreign asset pays with a check. How is it different? So you just go back to the textbook and see the difference there. There's a example in the book. And then number 3, crawling peg. Okay. So suppose country try to have a crawling peg with another currency. Let's say it just keeps depreciating. Okay, if the currency, let's say, if the currency keeps devaluating relative to the other currency, how does it affect? How's the domestic nominal interest rate related to foreign interest rate? Okay. Number 4 is about prices triplet. Okay, is there any question so far? Okay. So number 4 is about prices triplet, which is for actually the next for the last chapter, which I have not covered. I'm sorry, you have to read in advance, and I think it's good. Actually, it helps you to read in advance. I'm going to cover it anyway on Thursday. Just tell me what are the prices triplet, and tell me how a balance of payments crisis can be triggered by a loss of confidence of international lenders. So, and then these are a series of events. I want you to put them in the order in which they occur. And then I also ask you to talk about banking crisis, also a trick by that. And then number 5 explains a currency board. Okay, again, this is about the next chapter, the last chapter. So you have to read in advance. And first of all, find out what is a currency board and what are the policies that are adopted in the currency board, and why is it required? Why does it require to have a strong banking sector, healthy public finance, and flexible labor market, labor and goods market, if it is to maintain free capital mobility? Okay. So it's if you read the textbook, you would get some hint, and then you need to have a little bit of your own judgment. And then finally, that number 6 is, I think we covered quite a bit of it today, so that should be easy. Any questions? So I'd like to do the student evaluation now. Have you downloaded the HKUST iLearn? This is the app. Please download it and then do the evaluation now, because we have a little bit of time, just a little bit. And I can tell you this is the survey ID. Yeah, you can start doing it now, please. This is, I think it's Econ. You should be able to find it. ECON4374 L20 SI. This is the survey ID. And if you don't have this, F, this is the F, then you can go to http sfq.ust.hk/mobile. You can go to this as well, and you should be able to do it now, please. Maybe there's something called Fall 2000. Let's see. Maybe there's something called Fall 2018 or something like that in the front. Maybe. So please, please do it. Have you done it?
Yes.
Oh, you already done it. Okay. But yeah. So let other people do it. Okay, this is the app, okay? Are there any problem getting to that? Right, okay, now I've got the ID straightened out. It should be 1819 So 1819 fall, and then econ. So this is the ID. Please finish it before you leave, if possible. Anybody have any problem?